So if we have this booming economy, why aren't the banks lending? Just ask yourself that. Do they not want profit? Are they somehow not greedy? Of course not. The reason they're not lending is because the risk reward doesn't make sense, because when they look out at the real economy, they see storm clouds. They don't see a booming economy. They see a lot of problems. They see massive counterparty risk. I mean, let's not forget that we're just in the middle innings of a banking crisis. We know the banks are seeing this because we don't have to watch what they say or listen to what they say. Just watch what they do. I don't think they can stop the banking crisis. They might be able to paper over it and just kind of, where a bank fails here, they can kind of contain it, maybe. But I don't, this still has to play out. Fed is always behind the curve, Michelle, and they're always responding. They're always reacting. They're always responding to a crisis. That's why my base case would be that we have a hard landing and we don't have a soft landing.
On the Spot with Michelle Makori is brought to you by Swan Bitcoin.
Hello, I'm Michelle Makori. Thank you for joining us. The U.S. economy is seemingly going strong and inflation is starting to come under control. At least that's according to the latest eco data. GDP increased at a 2.8% annualized pace in the second quarter, above the 2.1% forecast and well above the 1.4% GDP in the first quarter. Now, according to the Commerce Department, gross domestic product was boosted by a strong consumer, government spending, and a sizable inventory build. Meanwhile, a key inflation measure for the Fed, the Personal Consumption Expenditures Price Index, increased 0.1% in June and was up 2.5% from a year ago, with the annual rate showing a slight decline from the prior month. Core PCE, which excludes food and energy prices, was up 2.6% from a year ago, so all closer to the Fed's 2% inflation target. Now, despite the data pointing to a soft landing, my next guest says that the world's most powerful economic indicator is signaling a recession is near, that the banking system is also flashing warning signs, and that his base case is a hard landing. George Gammon is a renowned investor, macroeconomics expert, and the host of the Rebel Capitalist Show. He's also a very successful entrepreneur and an educator known for his unique ability to explain complex topics in a clear, easy to understand way. George, very good to have you back with us and looking forward to you breaking down some of these concepts in a way that's easy for us and our viewers to understand.
Michelle, it's great to be back. It's always a pleasure to talk.
So, George, you point out that the world's most powerful economic indicator, the yield curve, has been inverted for more than 2 years now, and now we're starting to see signs of it uninverting, and that this is very significant because that is actually when the economic trouble begins. But before we get into the specifics there and breaking down the yield curve and what it means, let's start off with a broader overview of your macro outlook right now, especially with reference to this new data that seems to suggest that the economy is growing and inflation is starting to come under control. What's your read on this?
I think it all ties in together, because if you think about why the curve inverts, it starts with the banking system and the financial institutions, not only in the United States, but outside of the United States. Because banks have balance sheet capacity, which they could allocate in several different ways. Number one, they could lend into the real economy to entrepreneurs and businesses who are trying to create more goods and services. Or they could go ahead and buy the 10-year Treasury. Let's say just the risk-free asset with safety and liquidity being a premium. So what happens when you go into a cycle like we're in right now, that we've seen over and over and over and over again, going all the way back to the 1950s, is the banks and the entities in the financial economy start to take risk off the table, because they look around and they say, okay, there's no good opportunities out there to lend when you look at the risk versus reward. It's not just the reward, you have to include the risk. So what they do with all that balance sheet capacity is they start buying the long end of the yield curve because that's their best bet. And that, along with the Fed increasing interest rates, is usually when you get the inversion, which is just a fancy way of saying short-term interest rates are higher than long-term interest rates. So it's all just the market telling you that there's a lot of risk out there that a lot of times the stock market, quite frankly, isn't pricing in. And whenever you get I mean, you talked about 2.8% GDP growth. Okay, well, let's put things into perspective. It's not that like that's awesome year over year. I mean, it's higher than expectations, but expectations were incredibly low. When you look at the trend line, that's still below trend growth. And as our good friend Jim Rickards always points out, that's the definition of a depression, an economic depression. Another thing that I would say is if you look at these economic cycles, I mean, going back to the GFC, Michelle, how many people were out there preaching in 2000, even at the beginning of 2008, that we were in a recession? Now, everyone, if you look at the Wall Street Journal, the archives, which I do a lot, they're all talking about a soft landing. They're talking about the genius of the Federal Reserve, how they just brought interest rates down to a perfect level or up just to a perfect level to where they can, beat inflation, but they don't have to worry about jeopardizing the unemployment rate going up too high. People say this stuff. It's just unbelievable. How this time it's different, Michelle. This time it's different. This time it's different. Now, the cycle has been longer than usual. What we typically see is 18 to 22 months. As you said earlier, we've gone about 24, a little over 2 years, but that's assuming we're not in a recession right now. And you say, George, well, how can you say that if you've got real GDP growth at 2.8%? Well, fine. That's also assuming that the CPI or the deflator that they're using is actually accurate, right? Because that's real GDP. So if you take nominal GDP and let's say you deflate it by 2%, and that's what gives you the 2.8%, but really the deflator is 5% or 6% or 7%, which I think most of your audience would agree is the real inflation rate. Well, now all of a sudden you've got negative GDP if they just kept if they just really calculated the numbers honestly or more honestly like they did in the 1970s and the 1980s. But all the proof that we need is just sitting right there in the bond market.
All right. I get that, we always have to take this government data with a very, very big grain of salt. I want to, though, go back to the whole yield curve thing and just have you unpack that a little bit simpler for our viewers. An inverted yield curve, as you mentioned, that forms when you've got short-term debt instruments having higher yields or a higher interest rate than longer-term debt instruments of the same credit risk profile or similar. That's an important point as well. And then an inverted yield curve is unusual because a normal yield curve slopes upwards, displaying yields that run from low to high as maturities increase. And then usually an inverted yield curve signals a recession. Depending on which duration point you think is the most relevant, the yield curve has been inverted either since July of 2022 or October of the same year, depending what short-term instrument you're using it against. The yield on the 10-year Treasury has been lower than most shorter dated debt instruments since 2022. And as you just said, that's an inverted yield curve. And that has preceded nearly every recession going back to the 1950s.
Yeah, not nearly.
Okay, every recession going back to the 1950s. But
That's right.
But here's what the mainstream is saying, that the downturn is supposed to occur within a year or at most 2 years of an inverted curve. And not only did that not happen, at least according to the measure of GDP, but the GDP data is robust and we're not getting a recession, at least according to the technical terms. And a lot of them are saying, we should dismiss this as an indicator. So explain why you think otherwise. What's really going on then?
Well, again, let's go back to the banks and look at what the banks are doing and I go back to the banks because they're the ones that have the most intel. Right? They're the ones that are dealing with the entrepreneurs. They're the ones that are dealing with the multinational corporations. They're the ones that are dealing with commercial real estate. They're the ones that are dealing with the consumer. And most importantly, they're the ones that are dealing with other banks. And as you know, Michelle, most of the dollars in the world are created by lending them into existence, meaning the banks create the majority of the dollars. It's not the Federal Reserve or the Treasury or the government or anything like this. It's the banking system lending them into existence. So just look at the monetary aggregates. I mean, since 2022, M1 money supply and M2 money supply in the United States is down. And to give your viewers some context, the last time that happened with M2 money supply, we were in the Great Depression. Not the Great Recession, the Great Depression of the 1930s. So if we have this booming economy, why aren't the banks lending? Just ask yourself that. Do they not want profit? Are they somehow not greedy? Of course not. The reason they're not lending is because the risk reward doesn't make sense, because when they look out at the real economy, they see storm clouds. They don't see a booming economy. They see a lot of problems. They see massive counterparty risk. I mean, let's not forget that we're just in the middle innings of a banking crisis. We go back to 2023 with Signature, First Republic, and you know, to your earlier point, Credit Suisse. We were talking about that before we started recording. How all these banks basically went bust in March of 2023. They came out with the Bank Term Funding Program, the BTFP. The Fed had to come in and quote unquote save the day, but all they do is just really kick the can down the road. And since that time, for whatever reason, the mainstream media thinks that, oh, we dodged a bullet. You know, we have averted the crisis. Well, no, you didn't, because every single month we hear in the news that another bank goes bust, another bank goes bust. And not just in the United States. You say, oh, well, George, it's just the mid-sized banks with commercial real estate. Okay, well, that matters, believe it or not. That actually matters, and that impacts the big, huge banks, not only domestically in the United States, but maybe to the same degree, these banks outside of the US in the Eurodollar system. Why? Because it increases counterparty risk. And if you increase counterparty risk, you decrease dollar liquidity, because the banks are the ones that provide that dollar liquidity to begin with. But then we fast forward more recently and we look at Norinchukin Bank. Another thing that we discussed earlier, there's this big Japanese bank that had to take a $10 billion loss, billion with a B, because their dollar funding costs went up, because you guys know that the way banks make money is they borrow short-term and they lend long-term. Well, that's fine when your borrowing costs are 1% and then you buy treasuries at 3%. But what happens when your short-term borrowing costs go up to 5.25%? Well, the 3% that you're making on the treasuries now all of a sudden becomes a loss. So you have a negative carry on those. And this has nothing to do with the deposit flight that we saw with Signature, First Republic, or Silicon Valley Bank back in March of 2023. This is a completely different risk that the banks are facing. So what they inevitably have to do is they have to sell those assets that are yielding 3%. Those are the risk-free assets, i.e. treasuries, the ones that you're guaranteed to at least get your principal back. Yeah, you can debate as whether or not your purchasing power is the same, but you're at least getting your principal back. They have to sell all those, and they have to buy an asset that is yielding more than their funding costs. Let's assume their funding costs are 5%. That's what they're paying on the liability side of their balance sheet. Okay, great. Well, think about how far out the risk curve they have to go to get 7 or 8%, which is exactly what they need. Well, if we listen to what their statement was when they announced this $10 billion loss, they're going to have to, the only way they're going to be able to get that return they need is to buy CLOs, to buy derivatives. And what's the underlying asset for these derivatives? Oh, well, that would be commercial real estate in the United States. And it would also be junk debt, which, by the way, these corporations, they can't get normal debt from a bank. So they have to go to some guy, a sponsor for a CLO, which is borrowing money from the bank to give it to the lender, or excuse me, to give it to the borrower that can't get it from the original bank to begin with. So you have this massive daisy chain of risk. And what these banks realize is that they're all interconnected. People think that, oh, well, if Silicon Valley Bank goes bust or Norinchukin, well, it doesn't really matter to the whole system. They look at it as though it's an isolated instance. And what they have to understand is the global monetary system is simply a network of bank balance sheets. You know, the example that I like to give people, Michelle, to understand how the banking system works right now. Let's remember, if the banking system fails, guess what happens to the economy?
freezes up, it fails
crashes
as well. Yeah.
It crashes. There's no way that you can have a banking financial crisis and not take the economy down with it. That's just the way things, it's not the system I want, but it's the system we have. So going back to the example that I like to give people to get a visual of how the banking system works, it's very similar to these Tour de France races. You know, if you go back to the 1800s, the way the banking system was set up, it was interconnected to a certain degree, but not extensively to where there was all this systemic risk. So if you had one bank go bust, Michelle, back in, let's say, the late 1800s when we had free banking, it would be similar to seeing one of these bike crashes in the Tour de France where the guys at the front of the pack are separated by like 20 yards, where each guy is, there's 20 yards of distance between him and the next rider. So if one guy crashes, gets a flat tire, goes over the wall, well, it sucks to be him, but it only impacts that one rider. That's the way the system was. But you fast forward to the 1950s when the Eurodollar system was created as a result, a free market creation, by the way, as a result of Bretton Woods. Because the way Bretton Woods was set up, the global economy depended on the United States running deficits to the extent where there were enough dollars getting out of the US. And the US couldn't do that. So the banking system outside of the US said, well, we have all this demand for dollars. We'll just create these dollars by ourselves. And now we don't have dollars. We don't have bank reserves, but we'll just create these dollars by lending them into existence. So the offsetting asset is just simply that dollar asset that we just created by XYZ Corporation borrowing the money. And then what happens is when they transfer that liability that they just created to another bank, well, that bank just extends them credit. And they go back and forth and back and forth and back and forth to where every single bank's assets are the other bank's liability and vice versa. You see, so then we get to the 1950s where it's like a Tour de France crash where they're not just separated by 20 yards. Let's say they're more tightly together. Now, they're not all compact, but they're tightly together, let's say in a straight line. So if one guy goes down and gets that flat tire, he takes out, let's say, 5% of the other riders.
Right.
But now it's to the point where every single rider isn't yards apart or inches apart. They're millimeters apart. They're millimeters apart. So if one of these bikes goes down at the front of the race, I think they call it a peloton, then it just wipes out. It's like a domino effect.
Right.
It just wipes out all these other riders where 90% of them fail. And it's the exact same way the banking system is set up right now. And we know the banks are seeing this because we don't have to watch what they say or listen to what they say. Just watch what they do. And the fact of the matter is they're not lending into the real economy. They're buying treasuries, which are the safest and most liquid assets for the banking system. And this tells you that they're looking out at the other riders and they're seeing the guys at the front of the race. And they're seeing that every single one of them is about to have a flat tire, even though they're going 50 miles per hour. So because then that's a reference to GDP. So you look at GDP and you say, oh, it's 2.8%. Right. Well, the banks are telling you that although it's 2.8%, that there's a very high probability that it's going down to negative very soon. And again, it's not what they're saying. This is not George Gammon's opinion. It's just me looking at the reality of how they place their own bets and what they do with their own money.
So we have this sort of follow-on effect, as you're saying, as they're more interconnected. One falling means the domino effect kicks in. Let's talk a little bit about unrealized losses at the banks, because that's also pretty significant, yeah?
Absolutely.
And according to the data that we've got, unrealized losses across the US rose to $517 billion at the end of the first quarter of 2024.
Yeah, it was at 700. It was at 700. And just to give your audience some context, let's go back to the GFC. And Michelle, you're one of the best interviewers because you do a lot of homework.
Thank you.
It's really obvious. So I want to commend you on that first and foremost. But if you go back to the GFC, what do you think the unrealized losses were back then? I can tell you right off the top of my head, right around 75 billion at the height of the GFC.
75 billion.
billion.
Yeah.
That's right. Now 700, 10 times basically 10 times the unrealized losses. So the only rebuttal there is, oh, well, George, those are mostly treasuries or mortgage-backed securities or whatever. They can hold to maturity. They're not marked to market, so it doesn't really impact their balance sheet. Oh, really? Well, tell that to Silicon Valley Bank. Tell that to Signature. Tell that to Norin Chukin. The whole reason they're getting into problems, not the whole reason, but it's because they have to sell those assets which were hold to maturity. So they have to realize the unrealized losses. And that goes back down to credit risk. So if you want to talk to me about credit risk, great. Let's look at commercial real estate. Let's look at the junk debt. Let's look at how tight the corporate bond spreads are. Most people think that's a result of the market saying, oh, well, we don't see any risk out there. I beg to differ. I think it could be a result of all these foreign banks having to sell their safe and liquid assets and go further out the risk curve, not because they want to, but because they have to. And the only underlying asset that will give them that return is junk debt and so forth. And so then it compresses the actual spread. But now you look at the unrealized losses, which was a fantastic point. It's actually something I'd written down. You look at the credit risk out there with these banks just not being paid back. It's not just a commercial real estate. It's auto loans. Look at the delinquency rate there. Look at the delinquency rate on credit card loans. Do you think that these delinquency rates would be skyrocketing if we were in a booming economy? In fact, I read a report the other day, Michelle, from CNN. So this is not Zero Hedge or something like that. From CNN, stating that 39% of people they polled said that they worry about having the ability just to pay their basic expenses.
Yeah.
And to give you some context, that's up from 28% during the COVID lockdowns, and it's up from 37% at the depths of the GFC. The depths of the GFC. It's higher right now. People concerned about their ability to pay their bills. So tell me, if the economy is booming, if it's running on all 8 cylinders, why is it that 40% of Americans are worried that they're not even going to be able to put a roof over their head or put food on the table moving into 2025?
Well, George, you've got inflation and Bidenomics, and that seems to be the issue here, that people just can't keep pace with inflation, even though we're getting data that it's coming under control. I want to break down, what the Fed could do about this, if anything. But before we do that, let's still focus on the banks a little bit more, because last time we spoke was in November, and you warned of a potential banking crisis in March with the expiration of the Federal Reserve's Bank Term Funding Program, which was designed as an emergency bulwark against the looming threat of a regional banking crisis after what we saw in March of 2023, and that offered additional affordable liquidity to eligible depository institutions. That, as I said, that was set up after the March banking crisis, which you just referred to. That expired in March, and you were concerned that with that expiration, there would be a potential trigger for a crisis. Yeah. What happened there? How come we didn't see that?
Well, because I didn't. Well, number one, I was way off. Because I predicted like a 99% chance that they would actually extend the BTFP, and they ended up not. So I was very surprised, extremely surprised. But what they did, if you remember, Michelle, is Powell came out 6 weeks before the expiration and told the entire market that he was going to let it expire. So when we were talking, and I'm like, okay, if they let that expire, that could be a black swan event. What I was referring to is them just waking up that the day it expired and saying, okay, you're on your own, have fun. But wisely, you got to give them credit where credit is due. They wisely didn't do that. They really came out, I think it was about 6 weeks in advance, and warned the market they were going to do this. And therefore, the market was able, and the banks that were involved there were able to take measures necessary to shore up their balance sheet to where it wouldn't impact them to the point where they'd go bust. Now, I would say it would definitely impact them. And one of the ways that we can see them being impacted is by the fact that they're not lending anymore. So if the Fed, if this BTFP actually solved the problem, then you wouldn't see M2 money supply declining. You wouldn't see bank credit basically flat. because they solve the problem, the economy's booming, and you would expect the bankers to lend into the real economy because that's where they can make the most profit. But the fact is they're doing the opposite. So what that tells you is that, yes, the Fed did kick the can down the road. My hat's off to them. I didn't even think about them coming out and warning the market 6 weeks in advance. But that's what they did. The market didn't implode, but it doesn't mean that it fixed the problem. And you don't have to take George Gammon's word on that. All you have to do is look at what the banks have done since then. And oh, by the way, it's not like we haven't had any more banks fail. Domestically in the United States, we've probably had, I'm right off the top of my head, probably 3 or 4 banks fail since the BTFP. And also, too, remember they could borrow up to that last day of the expiration. So we still have to see how this plays out from the standpoint of all those banks that had to utilize the BTFP to survive. What happens when they have to pay those loans back? You know, we'll have to wait and see. It all depends on what's happening in the marketplace and what's happening to risk.
And
because,
they
like
also,
I said earlier,
go on.
Well, like I said earlier, the liquidity in the market is provided mostly by the banks. It's not really the Fed. So if the risk, the perceived counterparty risk is increasing, say that we're going into a market crash or a recession, it's going to be very difficult, if not impossible, for those banks that utilize the BTFP to get the liquidity they need without the BTFP once the clock, hits midnight and they've actually got to pay the Fed back. So they're not out of the woods yet, although I will definitely take my hat off to the Fed, and the way they handled that was, I think, the best way they could have.
And also they just created other mechanisms to get liquidity, just didn't name it in such an obvious way. There were just sort of other back doors, as we've had guests on the show like James Lavish explain, that they just facilitated liquidity in other ways to those banks. George, so let's assume that the Fed did an okay job in preempting that move. Can the Fed avert this in any way in terms of aggressive rate cuts, which now there's speculation that we could see 2 rate cuts in 2024, perhaps starting in September, perhaps even more aggressive than that? Is there a way that the Fed can take action to stop this banking crisis, which you say is already unfolding?
I don't think they can stop the banking crisis. They might be able to paper over it and just kind of where a bank fails here, they can kind of contain it, maybe. But I don't this still has to play out. And, going back to your earlier question, can the Fed basically engineer a soft landing? It's possible, but we have to look at probabilities. And what I can tell you is going back to 1950, Michelle, they never have. They never have. Not even once. So I would encourage your audience to pull up a Fred chart of the Fed funds rate and look at the Fed hiking cycle, and then just look at those gray shaded areas, which represent a recession. And show me the last time the Fed was able to just gradually bring down interest rates, Michelle. We're just going to do 25 basis points every quarter, and you're never going to know the difference. And we're just going to wake up in 5 years, and wouldn't you know it, the Fed funds rate is going to be at 3%, and the economy is going to be booming. If that's so easy, why haven't they ever been able to do it? What you see is the exact same cycle every single time. And then sometimes people point to the mid-1990s. They say, oh, well, the Fed had a rate hiking cycle there, and then they were able to, slow it down. We didn't get a recession. Right, the curve wasn't inverted. I mean, come on, let's be honest. The banks weren't giving you that signal that the stuff is going to hit the fan. They were still lending into the real economy. They were providing a lot of that liquidity. And by the way, there were no bank reserves effectively. There were no bank reserves back then. So you're comparing apples to oranges there. The entire curve was not inverted. But if you look at the typical cycle, and again, your viewers can look at a Fred chart of Fed funds, and they'll see what I'm talking about. It goes up, 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 and then it flattens out, and then the next move is always down. But it's not just down slightly, like taking the stairs down. It takes an elevator down. Because the Fed is always behind the curve, Michelle, and they're always responding. They're always reacting. They're always responding to a crisis. And that's also why the SOM rule is definitely applicable. And when you see unemployment go up, by, I think, I forgot her name. I think it's Claudia. Yeah. She came up with a great observation where she said, okay, if you got a 3-month moving average where the unemployment rate goes up by 50 basis points relative to its lowest point over the last 12 months, you're not only in or headed toward a recession, but we've never seen the unemployment rate just flatten out. Just, oh, it went up to 4.5. Oh, no problem. It's going to hover around 4.5. Then it's going to go right back down to 3.5. No, if it goes up and it breaks the SOM rule, then it just goes parabolic. And that's the stuff hitting the fan. That's always what the Fed is responding to. And that's what the yield curve sniffs out. That's because the banksters know about it first. I mean, let's sit back and just ask ourselves. We know how greedy the Jamie Dimon types are. The George Soros, I call them the financial insiders. Are you going to sit here and tell me that Jamie Dimon doesn't have any insider information as to what is happening with the global economy or the U.S. domestic economy? And I'm not saying it's illegal insider information, but he definitely has access to info with all these multinational corporations and these CEOs that come out on CNBC. He's having dinner with these guys every single night. So they're going to level with him. And he's going to say, hey, what do you think about the economy? I saw you on CNBC today saying that it's great. And then they sit down and have a couple whiskeys and like, no, Jamie, you don't understand. It's bad. It's real bad. And then he goes out. What does he do? He buys 10-year treasuries because he doesn't want to take the risk, which inverts the curve. So it's, again, I think they're just placing bets based on this insider information. And that's why the curve has such incredible predictive powers. It's not just magic. It's not fairy dust. It's not just happen chance. The reason it's so accurate, I believe, is because it's a representation of financial insiders that have insider information placing bets with their own money, not just what they say on CNBC or Bloomberg.
Let me just challenge this, just to play devil's advocate, with some reports that we've seen, like some articles in CNBC saying that the yield curve as an established recession indicator is broken. That's been the spin. And one of the reasons behind it is that the more coverage an indicator receives, the less effective it is. It gets too well known. It gets priced in. And Fisher Investment cites Factiva and says that in 2019 and in 2022, inversions prompted more than twice 2006's major financial press mention. So people were buzzing about this in 2019 and in 2022, and people were looking for the inversion. So they took preemptive steps with budgets and borrowing. So because it's been such a established recession indicator, people were on the lookout for it and acted accordingly. And now, according to some people, opinions at CNBC and perhaps some at Fisher Investments, it's broken. What do you say to that?
This is the idea that somehow the yield curve itself creates the recession. Like somehow the yield curve is what is impacting the market, and it's not a representation of what the market participants are actually doing. So they actually they get it wrong. They get it backwards. It's the dog wagging the tail, not vice versa. But this argument, let's just tackle it head on here, that the yield curve is dead. I like the fact that as they're saying this, the yield curve is playing out in the exact same way that it's done in every single cycle. So what am I talking about? I'm talking about the uninversion, not just the inversion, but the uninversion, to where the yield curve starts to steepen out. Because it can steepen out one of two ways, Michelle. It can steepen out through a bear steepener or a bull steepener, which again is just kind of nerdy macro econ guy speak for saying a bear steepener is when the curve steepens out as a result of the long-term interest rates going above short-term interest rates. So an example of this would be right now the 10-year Treasury is trading right around 4.2%. We got Fed funds, call it 5.2. So if we saw the 10-year Treasury go up to 5, up to 6, up to 7, this would be a result of a bear steepener. And that actually would be healthy. That's what you would want to see in a healthy economy. Now, it could be the result of the market predicting high rates of inflation, which obviously would not be good. But if we actually had a booming economy, this is what you would see. Why? Because then the banks aren't, and the financial institutions, they're not buying treasuries, which makes the price go down, the yield go up, because they're taking that balance sheet capacity and they're lending into the real economy because the risk reward makes sense. But now let's fast forward, or let's move over to the bull steepener. Now, the bull steepener is where the front end of the, okay, so let's go like this. We got the 10-year at 4.2. We've got Fed funds, let's say, or even let's say the 2-year. That's a better one to use. Let's say we've got that at 5%, just for the sake of the example. So if the 2-year starts going down, 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 as the 10-year is going down, but the 2-year is going down at a much faster rate, and then the 2-year goes down below the 10-year, then this is a bull steepener. And this is bad news. This is bad news. This is the treasury market. This is the bond market telling you that it's predicting that the Fed is going to drop rates, and they're probably going to drop rates sooner, and they're probably going to drop rates to a greater degree than the market, the talking heads on CNBC would lead you to believe. So this is the irony here. As all these people are coming out and telling you that the yield curve is dead, the yield curve is doing exactly what you would expect if we're going into a hard landing. And that's that it's steepening out, but it's steepening out as a result of the bull steepener. If your viewers go and look at a chart of the 2-year treasury yield and then the 10-year treasury yield, you'll see over the last 6 months, or the last maybe 3 months or so, I don't have the chart in front of me, the 2-year treasury has gone down to a much greater degree than the 10-year treasury, to the point where now the delta between the two is only 15 basis points. And by the way, Michelle, the 2 and the 30 have already uninverted, and they stayed uninverted, which is the key, because a lot of times they'll uninvert and then they'll go back to inverted and kind of chop around a little bit. But the 2s and 30s have already uninverted and stayed that way. The 5s and 10s, the exact same way. And this is, again, what you see in every single cycle. It always plays out this way. So for people to look at it and saying, oh, this time it's different, why? Why is it different? You can sit and give me that argument, well, it's a self-fulfilling prophecy, because once the banks see the yield curve inverting, or the market participants, well, then they're going to lend less. That was your prior argument. Okay, but fine. What's that going to do? If the banks lend less and provide less dollar liquidity, then that's going to, in and of itself, create a recession. That puts downward pressure on economic growth, because those entities that are out there that need the liquidity to produce the stuff that we buy don't have access to that liquidity. And if they do, they have to pay a higher price for it. So any way you look at it, that argument is not well thought out.
Okay, what about this? And again, not necessarily my argument, but just throwing it out there in terms of what some pundits are saying. And they're suggesting that the inversion's lack of negative impact shows or heralds a new economy where America's services sector is big and stable enough to overcome problems caused by an inverted yield curve in other credit-sensitive parts of the economy.
Again, the inverted yield curve, the problem with an inverted yield curve isn't necessarily the impact on the economy or the impact on the banking system, because the argument there is, well, it impacts banks negatively because they borrow short, lend long. That may be true, but that's not the real reason that you should fear an inverted yield curve, because the impact, the damage has already been done. Because what the curve is doing is it's not impacting something, it's a representation of what is actually happening and what the banks themselves are predicting will happen in the future. So anyone that starts with, oh, well, this is all about how the curve impacts this, and this time it's different. I mean, let's just stop for a moment, use some good old-fashioned common sense, Michelle. I'm sure you've got a lot of friends. Let's say one of your friends came to you and said, Michelle, I need to borrow $5,000 worth of gold. Right? And you said, okay, well,
better be a good friend, George.
Yeah, and you said, okay, well, how long do you need to borrow it? And they said, well, probably about a month or so. And you say, okay, well, what I'll do is I'll just charge you a pro rata interest rate based on the 10-year treasury, yada, yada. Let's say you charge them 2% interest, 2% interest for borrowing that gold for 2 months. Okay. Well, let's say they come to you and say, Michelle, I need to borrow $5,000 of the gold or however many ounces. I need to borrow it for 30 years. Are you going to charge them a higher interest rate or a lower interest rate?
Yes, there's more risk of me not being paid. So obviously I charge them a high interest rate, which is, obviously the whole premise of the yield curve. Yes.
So there you go. Yeah. If the yield curve is dead, if the economy is booming, if we've transferred into this new type of world where it's all services based and blah, 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 whatever excuse you want to make, it still doesn't make sense from a fundamental standpoint. If we are in a healthy economy, even if it's changed to services or AI or whatever you want to make up, the bottom line is that short-term interest rates should be lower than long-term interest rates. And if there's not, it's a representation of a big, big problem. And it's been this way every single time. And again, Michelle, if you go back and look at the archives for your viewers that have a subscription to the Wall Street Journal, you can go to their website. I do it all the time. You can look at the archives, look at the articles and what they were saying about the economy in 2007 and what they were saying in 2008 and what they were saying about the inverted curve and what they were saying about the probability that we would have a recession due to residential real estate. It was the exact same nonsense over and over. In fact, back then, it was the longest inversion of about 22 months. And, once it got past like 18, oh, well, look at that. The yield curve is dead. And then, boom, you get Bear Stearns. Boom, you get Lehman Brothers. You're like, oh, nobody could have predicted that. Yeah, except for that yield curve that's been inverted for the last 22 months.
Well, I will say that the New York Fed still assigns a 56% probability of a recession by June in 2025 because of the current gap in the yield curve. So, George, what does this hard landing look like? How does it play out? How do you see things unfolding from where we are?
No certainties, only probabilities. We could have a garden variety recession like we had in, let's say, the early 1990s, or it could be a GFC 2.0 like we had in 2008. If I'm going to put money on it, my base case is that it would be a much more severe recession. Maybe not to the degree to what we saw in 2008, 2009, but at the very least, something we saw during .com or maybe in the early 1980s at the very least. And the reason I say that, Michelle, is again, it goes back to the interconnectivity of the banking system. And it's almost impossible to have a super, super soft landing in the environment where everyone in the Tour de France is millimeters apart. And you have all this systemic risk. And then the banks are not only do they have this systemic risk, but they're forced to take on even more risk because they have to go out that risk curve to buy derivatives, for heaven's sakes, CLOs, because it's the only way they can manage their balance sheet and stay afloat. And then they just sit there and keep their fingers crossed that the Fed is going to drop rates to bail them out. But unfortunately, even if the Fed drops rates, they usually drop rates in response to a crisis, which although interest rates might be lower, the outstanding environment is even worse than it was before. And we go back to cycles. And this is the way it's always played out. And because of the amount of debt, not just on the public balance sheet, but on the private balance sheet, because of the economic distortions that were created during the COVID lockdowns. And it wasn't because of COVID. Let's be very, very clear. It was because the government's response to COVID. At some point, you've got to pay the fiddler. The rubber meets the road. And for all of these reasons and a lot more, that's why my base case would be that we have a hard landing and we don't have a soft landing. I would encourage any of your viewers, Michelle, to go back, just do a thought experiment. In late 2019, if I would have told you that all these insane governments around the world were going to lock their citizens in a cage for 2 years for 2 years in some cases, and they were not going to allow them to produce anything. They weren't going to allow them to actually work or produce goods and services, which, by the way, is the definition of wealth. And they were going to do this for 2 years. Basically, the global economy was going to be on deep freeze, on lockdown for 2 years straight. And I said, what would your base case be as far as coming out of that? You would have said an economic depression that makes the 1930s look like a picnic. It looked like a picnic. Okay, fine. Well, now we're on the other side of that. And do you think that just because we got some stimmy checks and just because we got some PPP loans that we just got a free lunch and we're not going to have to pay the price for the government's doing that to their citizens and completely destroying the global supply chains? Of course not. Of course not.
Could you say the price, though, is just crazy inflation and not necessarily a recession that goes with it as well? Could you just say that the price is devaluation and debasement of your currency, which, again, very bad in its own right, and inflation, but not necessarily an economic slowdown?
I think that definitely contributes to it. Absolutely. Absolutely. That's part of the price that we have to pay as a society, especially the poor and middle class. The fact that their wages have not gone up at the rate of consumer price inflation, the stuff that they have to buy, so their purchasing power overall has gone down, which is why we see the delinquency rates go up and all the things that we talked about before. 40% of Americans are worried they're not going to be able to put food on the table. But could the release valve only be consumer price inflation? Yeah, it could. It absolutely could. That's a possibility. But my view of the world is that that's a low probability, and that the higher probability is that we do have a hard landing in addition to that. And again, that's not me just pulling my opinions out of the air. It's not just me being bearish. All I am doing is looking at past cycles, and I'm looking at what the banks and the financial insiders are telling me based on what they're doing with their own money.
So when do you see this hard landing hitting? Like I said, New York Fed says June of 2025.
Yeah, so you can never get the timing down,
sure.
And I've definitely been early here. I'll admit, if you would have told me that we'd be in July of 2024 and we would not have had a negative GDP print or unemployment be at 4.1, I would have said the probability of that would be low. If you would have asked me that, let's just say 12 months ago. So I definitely got the timing wrong, for sure. But the way that you'll know if I'm wrong, if I've got this wrong in general, is when the curve uninverts due to a bear steepener. That's another thing that I've always said. The way that you tell if this time is different is you see an uninversion due to a bear steepener. And we're seeing the opposite. We're seeing the bull steepener actually play out in real time right in front of our eyes. So that's what was your question? Are you talking about positioning?
I was talking about timing, when you anticipate this hard landing to really hit. And as I said, New York Fed puts a 56% chance of it hitting by June of 2025.
Great point. So this is where I would look at narrative. And I think narrative is something that all of your viewers should really pay attention to.
Especially in an election year.
I'm sorry?
Especially in an election year.
Well, that's right. That's right. But more so, what I look at is the narrative that I see within the marketplace. And let me be more specific. When we go through these cycles, let's say 2013, 2014, we get to a point, and we'll just use the S&P 500 as a proxy for this, where good news is actually good news. So we see the unemployment rate start to go down. We see the economy starting to improve. We see home prices flattening out. And therefore, hey, this is great. Let's go ahead and take risk and buy some of the S&P 500. And then it goes up and up and up and up, and to the point where the good news starts turning into bad news. But the market, being always having this tendency toward being bullish, they say, oh, well, this bad news isn't really bad news because it means the Fed's going to drop interest rates. And we know that if the Fed drops interest rates, that's great for stocks, completely ignoring a possibility of a recession, right? But this is how the narrative changes. And so we go from good news being good news to bad news being good news. But we get to a point, Michelle, where bad news becomes bad news. And I think that there's a high likelihood that we hit that turning point, that paradigm shift, just the other day when we got the soft CPI report. So this would have been, I've been moving, so I've been out of the loop. You'll have to forgive me. I think it was a couple Fridays ago where we had a soft CPI report. So you would have expected, that's kind of bad news, but that means the Fed's going to drop rates a lot faster, at least the market perception. And therefore you would expect stocks to rip higher, especially the NASDAQ, especially those growth stocks like the Mag 7 or whatever they're called. But instead we saw the exact opposite. Now, initially I thought, okay, let's not jump to any conclusions. This could just be profit taking because these stocks are so up, and it could just be some sort of rotation into the Russell 2000 or something like that. But if you look at what has happened since then, the NASDAQ especially has continued to drop off a cliff, and it doesn't really matter what type of news we get, the NASDAQ still goes down. So I think just that rotation into the Russell was probably temporary, just because people were like, okay, we've squeezed out all the blood out of this turnip that we possibly can, the NASDAQ. And now we have to get some sort of return. And the only way that we're going to do it is buy these garbage stocks in the Russell 2000 that aren't even making a profit, because those should be better. It's basically like buying the unprofitable junior miners. Right? It's the transition from the big ones to the juniors that have much more risk. But at a certain point, they realize that, oh no, I've made a huge mistake here, because the unemployment rate goes up, the data the majority of the data gets softer and softer and softer. And that's when the market wakes up and realizes, holy cow, right, I am way off sides. Another example that I would give of that phenomenon, Michelle, was the debates the other day. Remember when Trump debated Biden? And prior to this debate, if you listen to the mainstream media and you even insinuated that Joe Biden might not be as sharp as a tack, what would they do? Oh, you're a conspiracy theorist. You're a tinfoil hatter. Okay, Alex Jones, blah, 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 right? But all of a sudden, it was the evidence, because of that live debate, was overwhelming to the point where the mainstream media could no longer try to convince you, try to manipulate you, try to gaslight you into believing that Joe Biden had not lost the majority of his mental faculties. That's an example of bad news becoming bad news. There's so much of it, the market says, okay, we've got to sell. And so this takes us back to the Fed dropping rates and what they might do. Once they start the cycle where they're dropping rates and dropping rates quickly, that's usually when you see the majority of the decline in the S&P 500. And so that's kind of the timing mechanism that I'm using for my own portfolio, is I'm just waiting until the Fed drops rates the first time. And I think we may see a surprise there in July. And if they do, that's when I'm really going to start taking action, assuming that over the next 6 months, we'll get that hard landing. And that will play out also in the S&P 500.
Right. So as you say, one rate cut is what the market wants. Two, but the minute the Fed is in a position where it really has to aggressively cut rates, you start to look at, why does the Fed have to do this? And as you say, bad news is bad news. You said you're expecting a cut maybe in July. The markets are pricing in potentially 3 cuts this year, according to the SME Fed Watch tool. They expect nearly 100% chance of a rate cut in September, 60% chance of another rate cut in November, and 57% chance of a third rate cut in December. That's according to the SME Market Watch tool. What says George Gammon's tool?
Well, in July, I'm not sure whether they meet next week.
Yeah, next week, 31st of July. Okay. Yeah.
I'm not. That's not my base case.
Okay.
But I think it could be an interesting bet, and the reason is because obviously there's some massive asymmetry there. So this is not investing advice. I'm just being honest with your viewers, and I'm just being as authentic as I can. I guess that's the word, and just telling them what I'm doing with my own portfolio. So right now I'm looking at that Fed meeting and saying, okay, if the market is predicting a 100% probability
For
that
September.
they just, no. I'm saying that they keep rates the same in July, that they do not drop rates, that they don't cut rates in July, right? If they're attaching a 0 probability to rate cuts in July, that might be interesting, because looking at all the Fed's indicators, look, the main indicator is the near-term forward spread, which is just a real wonky type of yield curve. But that's screaming recession right now, and we haven't even discussed that. And then their own beige book is also insinuating that we're heading toward a recession. So I think that there's a much higher than 0 probability that we do get a rate cut next week. But that's not to say it's my base case, right? I think it's just an interesting bet, because the market is attaching a 0 probability, and let's say it's even a 20% probability, there could be some very good asymmetry. And those are the 3 common denominators, the 3 hallmarks of every single great investor that has ever lived, regardless of what they invest in. It's number 1, they've got good risk management. Number 2, they take asymmetric bets. And number 3, they've got an edge. So I'm just looking at this possibly as an option for that number 2. Not saying that I'm a great investor. I'm just trying to emulate the greats.
Well, you've had a pretty solid track record yourself, George. I appreciate the false modesty, but you've had a pretty solid track record yourself, which is why we have you on the show. Regarding the Fed, it's interesting because Mohammed El-Arian, Chief Executive Officer of PIMCO, former Chief Executive Officer of PIMCO and Chief Economic Advisor at Alliance, he wrote an op-ed in Bloomberg saying that the Fed may be 2 meetings away from a major policy mistake, saying that a soft landing for the U.S. economy could too easily slip away if unhelpful, noisy data delay an interest rate cut beyond September. So he's urging for definitely a September cut. Some are saying it's already too late. What do you think? But as we said earlier, you don't even think that it makes a difference in terms of how many cuts we get for the bigger picture.
Well, we're going to get a lot of, my base case is once they cut, it's not going to be by 25 here and 25 there. They're going to cut by 25, and then it's going to be steep. It's going to be, then they're cutting by 75 basis points in the next meeting, or 100 basis points or something like that.
Wow.
I just, as a thought experiment, Michelle, I just go back to the GFC. And if my memory serves me well, they started cutting rates, I believe, at the end of 2007. I don't have a chart in front of me, but that's what it, I think that's what I remember. And so the question becomes, would they have avoided a GFC if they would have just started cutting rates maybe 6 months earlier? My answer is no, not likely. And the reason is because the overwhelming problem was the fragility in the monetary system. It was the fragility in the monetary system. And just with a few rate cuts, I mean, that might have done a little bit to soften the blow, but you're not fixing the problem at all. It's basically, you've got someone that's drowning, and you just, you give them just one gasp of air, and that's doesn't help them. They're still going to drown. It's just might take a little bit longer, or the drowning, well, I guess that case, it couldn't be any worse. But you understand my point. And so I don't think they could have avoided it. And most people think that the GFC was a result of the real estate market blowing up, but that's really not true. That was a catalyst, but that's because the monetary system was so fragile. It was all built on collateral such as T-bills and mortgage-backed securities. So when overnight you took away that collateral, which was the mortgage-backed security, the whole entire system imploded, which had this ripple effect into the real economy. So then you've got to ask yourself, okay, well, are the problems within the monetary system bigger now or smaller now than they were in 2007? And it's obvious that they're much, much bigger now because of the growth of the Eurodollar system and the overall global economy. And the way they've achieved that growth or that expansion, Michelle, is due not to the production of goods and services, but to financial engineering to a greater extent. So if we had, let's say, X amount of financial engineering that took us to 2007 and that amount of systemic risk, now we have X plus Y. So you would assume that the counterparty risk and the systemic risk in the system would also be greater. So when you do have whatever catalyst it is, I don't know if it's going to be commercial real estate. I don't know if it's going to be election. I mean, I hate to even go there, but just based on what happened the other day, it could be an assassination or who knows what black swan event, but that's the catalyst that really impacts what's most important, and that's the fragility of the global monetary system, which there is no way we have fixed since the GFC.
No shortage of potential triggers for black swan events, George. We're in an election year. As we keep on mentioning, there's so many geopolitical flashpoints around the world that could really flare up. There's so much volatility and so much uncertainty in the political landscape in the US. Now, with the Democratic Party looking like making Vice President Kamala Harris their nominee to run against Trump. That's still not 100% determined, but that's how it's shaping up. And, we've had guests on the show that say, hey, if you're a nefarious actor on the world stage and you're looking for a time to strike, this is your moment, whilst we have all of this chaos and uncertainty and division and
and you're spread too thin, because think about that. You have all those domestic problems, but then you've got problems in the Middle East. You've got, most people forgot, but oh, by the way, there's still Russia and Ukraine. Right. They're just kind of out of the news cycle. So we'll just pretend that doesn't exist anymore. And then, oh, by the way, you've got China, Taiwan. Right. And this is a very, very tumultuous time. And as we said, an assassination attempt on former President Trump, which also sort of got buried underneath the whole Biden dropping out. Just the news cycle is just happening so quickly, and so many events that could trigger some kind of action. So it's interesting, George, that you said you would see a 25 basis point cut followed by bigger increments, 50, 75 basis points at following meetings. Just to circle back to what you said that. They might even cut more. I think it's probably a low probability, but it's possible they cut straight down to zero. Let's not forget what they did during March of 2020. Wait. From 5.25 to 5.5 straight down to zero. That's sure. That would be outrageous. That in itself would signal disaster looming, to drop rates from 5.25 to 5.5 straight down to zero. Sure, but I'm not saying it's a high probability event, but it's above zero. That's for sure. And I would give it, 5%. Wait, let's think about this. We go back to March of 2020. Remember what happened back then? Interest rates were right around 1%, I believe, something like that. And they were on the tail end of a rate hiking cycle, but then we had the repo blow up in September of 2019. We're like, oh, sorry, we got to drop rates a little bit. But then they were supposed to meet, I believe it was on a Wednesday, Michelle, and they had an emergency meeting on a Sunday. And they did what? They took it straight. They didn't drop by 25 basis points. They took it straight down to zero. Straight down to zero. But from 1 to 0 is a big difference, George, than 5.25 to 0. Right. But if you have World War III, you don't think they're going to take it down to zero? You think they're just going to take their time and do 25 basis point cuts? Well, I don't know about that. Look, who knows? As I've said, anything's on the bingo card for 2024, but that would be... I think that's the moral of the story. That's the main takeaway here. expect the unknown, but given all of this... Your audience needs a bigger bingo card, Michelle. That's the main takeaway. Yeah, put anything out there, because you just don't know what's going to happen. But given all of this, George, you still have a portfolio. You're still trying to position yourself to protect your wealth, perhaps even make some money in this uncertainty and chaos. What are you doing on that front? Well, what I'm doing with my own personal portfolio is I've got two separate ones, but we'll go with the one that's kind of more short term, a little more exciting for people. Is I've got gold. That's always the foundation of every single one of my portfolios, about 10% there. And I just buy it as insurance. It's not even because I think gold's going to 5,000 or 10,000 or anything like that. It's just, it helps me sleep well at night. Then with the rest of the portfolio, and this changes all the time, I've got 1-year T-bills. And what I do is I take the interest that I'm making from those T-bills and I buy call options. And so I buy long dated, way out of the money call options on something like the NASDAQ, right? So now let me be very, very clear. Michelle. This is the way my portfolio was set up from about April, the beginning of April, right around there, of this year. Because the way I thought is we're either going to have one of two things happen. Either the market is going to crash or we're going to have a blow off top. And we're just going to have a crack up boom, if you will. And so I wanted to be positioned accordingly, but the main thing that I want to do in my portfolio is not lose money. So if I'm buying call options with the interest that I'm making on the treasuries, then my principal is never at risk, right? Now that said, when we had the CPI report the other day, where in my view, the bad news might have become bad news, I immediately sold all the call options, immediately. As soon as I saw that report, as soon as I saw the market didn't respond by going up, now all of a sudden, my thesis, my hypothesis, my reason for placing the bet was invalidated. So I immediately sold, and that turned out to be the right thing to do. So now what I'm looking for this dry powder is to wait for the Fed to drop rates that very first time. And what happens is the stock market usually goes down by the largest percentage after that, but long-term treasury yields usually go down a lot as well, or even the 2-year treasury yield. So I haven't done anything. Again, this isn't investment advice, but what I'm looking to do now is take that dry powder and have a bifurcated portfolio. So I've got all the liquidity with the T-bills I need to buy things on the cheap when and if assets go down, like we saw during the GFC, when the S&P 500 went down by 50%. So I want to be a buyer, just like I was in March of 2020. You know, most people think I'm always bearish. No. I was wildly bullish as far as stocks during March of 2020. And that's what I want to have the liquidity to do. But I also want to have those call options there placed on what I think is the highest probable outcome to add asymmetry to the overall portfolio, just like I had asymmetry with those call options from April to the other day when I sold them when they were up. I mean, some of them were up 300%.
Well, George, I believe that when we spoke in November at the New Orleans Investment Conference, you told me that you had zero exposure to equities back then.
Yeah, back then it was T-bill and chill.
You said T-bill and chill. That's exactly what you said. You had zero exposure to equities. And look, you just said you were early. You just said so earlier. But you lost out on what, like a 19% appreciation, more or less, on the S&P 500 since then.
Yeah, but I made it back by buying those call options on the NASDAQ in early April. And I mean, look, if I give up a 19% return every once in a while, but I replace that with a 300% return, I'm okay with that.
That sounds like solid math to me. George, what about Bitcoin? How do you see Bitcoin playing here?
Well, I think everyone should own Bitcoin. And I think Bitcoin has been a huge success, even if it doesn't become global money, but maybe for different reasons than most. Most people think that you should own Bitcoin because it's going to 1 million or 10 million or whatever the number is. That may be true. But the real value I see in Bitcoin, especially right now, is the ability to move your purchasing power across borders. So it would be the portability of it. And if I think most of your viewers out there are considering or should be considering a plan B option, especially if they live in the United States, based on the volatility that we were talking about earlier. And if you actually try to do that, it's very difficult to take, let's say, $250,000 worth of purchasing power with you on a plane going down to Argentina, as an example. Let's say your plan B is to hang out with our good friend Doug Casey down there. It's almost impossible to do with gold. It's literally impossible to do with silver. The best way to do it is with Bitcoin. That's the bottom line. And I actually did a road trip across Argentina a while back. We called it the Road Trip to Freedom Challenge, where I tried to go all the way across Argentina using nothing but gold, silver, and Bitcoin. And it was very difficult, but the ease of mobility with Bitcoin was head and shoulders above the rest. So for that reason alone, I think everyone should own Bitcoin. Now, as far as the price, what do I think the price is going to do? I think just the way Bitcoin is engineered and the with the halvings and whatnot. And it is true that we were talking about the Bitcoin conference right now, how they've got, who knows, 15,000 people. And these are diehard fans. I mean, you could call it a cult, you could call it a religion. They may be justified, but the bottom line is these people are hardcore into Bitcoin. And it's not just an investment for them. It's their way of life. It's who they are. Right. And they're never going to sell. They're just never going to, they're just not. Right. So if you look at that, and you also look at that through the lens of how it's engineered with the halving, and I think there's going to be greater and greater demand, even if it's not for money or for a medium of exchange, there's going to be greater and greater demand to have an asset with no counterparty risk. And more importantly, an asset that is totally, totally portable. So I don't know what the price is going to do over the next 3 months, 6 months. I mean, who knows with the volatility, but I do think over the next 5 years or so, it would be a good bet to have that in the speculative side of your portfolio.
Right. George, as we wrap up, you have to get your thoughts. I know you're joining us from Colombia, but obviously the US elections are top of mind for a lot of people around the world. Do you have any predictions or forecasts as to how you see that playing out?
Oh, if I had to put money on it, it would be Trump. I mean, after he got shot the other day and he came out and was, pumping his fist and saying, fight, fight, fight. And then there were rumors that he was actually going to go to the UFC fight after that. Oh my gosh. I was going back and forth on Twitter with Brent Johnson. And I said, look, if he actually does go to the UFC fight right now, you could bring Abraham Lincoln back to life and Donald Trump would still beat him in an election. He's unbeatable at that point, right? Just on that picture alone with him and the American flag behind him and the blood going down his face and everything. So I think that nothing's 100% for sure, but I think it's you have to put your money on Trump. You absolutely have to. Now, will they rig the election? Will they steal it? Will there be another, heaven forbid, another person that will try to take his life? Yeah. That's got to be on the bingo card. Got to be on the bingo card. But if we have a fair, straightforward election, I don't see how Trump loses.
Like we said, everything's on the bingo card for 2024. George, we're going to wrap it up here. Thank you so much for your analysis, for your insights. We really appreciate having you on, George Gammon.
Oh, thanks for having me.
All right. And as always, thank you for watching. And again, I'd like to also do a special thanks to our sponsors, Swan Bitcoin. Want to mention them. And they're a reminder to our viewers that Swan does offer an IRA product, which allows you to invest directly in Bitcoin with your IRA. And there's a way to set it up that you're basically buying Bitcoin on autopilot. And that allows you to take advantage of dollar cost averaging as you accumulate Bitcoin into your IRA. There is a link in the description with a special offer for Kitco viewers to help you facilitate that process. So check that out. And thank you again for checking out this video. From me, Michelle Makori, and the rest of the team. We'll see you again soon.
On the Spot with Michelle Makori is brought to you by Swan Bitcoin. Swan Bitcoin IRA. Your legacy, your way. Real Bitcoin, not proxies. Traditional and Roth IRAs. Fast, easy setup. Start now at swan.com/retire.